If you've been keeping an eye on the markets, you know that artificial intelligence is absolutely the name of the game right now. I mean, it's a full-blown tech revolution. But while all the attention seems to be on these massive companies down in the United States, what does this AI boom really mean for investors right here in Canada? Is it even possible to get in on this incredible growth story without having to look south of the border? Well, today we're going to find out.
So, what if I told you that this number, yep, over 350%, is the one-year return of a Canadian tech stock? It's true, and we're not talking about some tiny, high-risk penny stock here. This is an established Canadian company that delivered absolutely explosive growth for its shareholders. While the giants down south are grabbing all the headlines, something really powerful is happening right here at home. And when smart investors see this kind of performance, it naturally leads them to one really big question.
This is the question on every investor's mind, isn't it? You see the mind-blowing growth from companies like Nvidia, you hear about the trillions, with a T, trillions of dollars pouring into this sector, and you start to wonder, hey, should I be getting in on this? Can I take part in this? And how do I even do it from Canada? It's a great question, and in this video, we're about to explore the answers.
Welcome to another video on investment basics by Mr. Majid Butt. Navigating the world of AI investing can be pretty tricky, which is why this analysis is grounded in a really unique blend of expertise. We're talking the fundamentals of accounting, the logic of software programming, and the detailed diligence of investment research. The whole goal of this video is to give you that clear foundational knowledge you need to start your journey. So here's our game plan for today. First, we'll break down what an AI stock even is. Then, we're going to zoom right in on the Canadian landscape and take a really close look at 4 specific companies. After that, we'll zoom back out, see what's happening beyond our borders, and talk about other ways to invest, like using ETFs. And finally, we'll wrap it all up with some key takeaways to help guide your decisions. So let's get started.
All right, first things first. The term AI stocks gets thrown around a lot. You see it in headlines, you hear it on the news, but what does it actually mean? Before you can invest in anything, you really have to understand it. So let's cut through all the hype and get a simple, practical definition.
At its very heart, AI is all about creating smart machines. But smart is the key word. It's not just about a machine following a set of instructions. It's about learning, adapting, and actually getting better over time. Think about your daily life, when your phone recognizes your face to unlock. That's AI. When Netflix recommends a new show that you actually want to watch, that's AI. When your bank flags a weird transaction on your credit card, yep, that's AI too. The truly revolutionary part is that these systems get smarter all on their own, just by processing more and more data. And this ability to learn and make decisions is what makes AI so incredibly powerful for businesses.
Now, when we talk about AI stocks, it really helps to think of them in 2 main buckets. On one side, you've got the makers. These are the companies selling the pickaxes and shovels during the gold rush. They build the fundamental tools, the computer chips, the complex software, the cloud platforms that make all of this AI stuff possible. Then, on the other side, you have the users. These are the companies using those pickaxes and shovels to go find the gold. They take that AI technology and apply it to their own business to get more efficient, create better products, or just crush the competition. So Amazon uses AI for logistics. Netflix uses it for recommendations. Understanding this difference is absolutely crucial because it represents 2 very different ways to bet on the AI revolution. So why is there so much excitement? Well, this number really puts it all into perspective. According to a major forecast by PricewaterhouseCoopers, AI is projected to contribute up to $15.7 trillion to the global economy by 2030. To help you grasp just how massive that number is, it's bigger than the entire current economy of China. This isn't just some niche trend for tech nerds. No way. This is a prediction for a fundamental rewiring of the entire global economy, affecting everything from healthcare and manufacturing to retail and finance. This is the giant wave that investors are hoping to ride.
With all that global potential, it's pretty easy to think you have to look to the US markets, to Silicon Valley, to find the best opportunities. But the great news for Canadian investors is that you don't. Canada has its own thriving AI ecosystem with high-quality, innovative, and established companies trading right here on our own exchanges. Let's take a look.
And you really don't have to look very far to find them.
This list just gives you a taste of the sheer diversity of AI-related companies on the Toronto Stock Exchange. You've got names like BlackBerry, using its security smarts for the Internet of Things, Kinaxis and supply chain management, Docebo and e-learning, and even a giant like Thales, using AI to make its network better. This just goes to show that AI isn't a single industry. It's a technology that's being woven into the fabric of pretty much every part of our economy. And hey, investing here at home means you don't have to worry about currency conversion fees eating into your returns.
Okay, so that overview shows you the breadth of the opportunity, but now it's time to go deep. General knowledge is good, but making smart investment decisions requires specifics. So we're going to take a much closer look at 4 of these companies to really understand their business, their financial health, and exactly what they're doing in the world of AI.
First up is an Ottawa-based software company called Kinaxis. Now, these guys operate in one of the most complex and, frankly, critical areas of the global economy, supply chain management. Just think for a second about everything that had to happen for the phone or computer you're watching this on to get into your hands. Kinaxis builds the AI-powered brain that helps massive global companies manage all that complexity. Their main platform, Rapid Response, lets companies see their entire supply chain in real time and, this is the cool part, run simulations to see what might happen if there's a problem, like a factory shutdown or shipping delay. It is an absolutely indispensable tool.
So what makes Kinaxis so compelling from an investor's point of view? Let's break it down. Their SaaS revenue, that's just software as a service, which means predictable recurring subscription money, is growing at a healthy 17%. And get this, their net profit jumped 150% year over year. That is huge. But here's the real secret sauce. They're sticky blue-chip clients. Once a massive company builds its operations around Kinaxis' software, it is incredibly difficult and expensive to switch to a competitor. This creates what investors call a moat, a really durable competitive advantage. And to top it all off, they have a debt-free balance sheet. In today's world of rising interest rates, that is a massive sign of financial strength. Next up, we have Celestica, and this is the company behind that incredible 350% return we saw at the very beginning. For years, Celestica was kind of known as a regular contract manufacturer, but the company has pulled off a brilliant transformation. They have become a critical supplier for the gigantic data centers and cloud infrastructure that form the physical backbone of the entire AI revolution. Basically, if AI is the brain, companies like Celestica are building the skull and the spine that protect and connect it all.
And the story behind this growth is just fascinating. The stock is up over 350% in a single year, and it's being driven directly by what's called the hyperscaler AI build-out. Hyperscalers is just a fancy term for the biggest names in tech. Think Meta, Microsoft, Amazon, and Google. These giants are in an all-out arms race, spending tens of billions of dollars every single quarter to build the data centers they need to win in AI. Celestica is a direct beneficiary of all that spending. They provide the complex hardware these giants absolutely need. With analysts thinking their earnings could more than double by 2028, Celestica is a direct bet on the continued explosive growth of AI infrastructure.
Our third company, OpenText, offers a different kind of opportunity. This is not a high-flying growth story like Celestica. This is a well-established, profitable software giant from Waterloo that is making a very careful, deliberate pivot toward AI in the cloud. For decades, they've helped the world's biggest companies manage their huge amounts of information. Now they're plugging in their own AI platform called Aviator to make all that information smarter and more useful. This makes OpenText a really interesting prospect for investors who might be looking for value and a bit more stability.
What's really compelling about OpenText is its balanced appeal. For starters, it pays a dividend of nearly 2.8%. That means you actually get paid a steady income just for owning the stock. On top of that, their EBITDA margin, which is just a key measure of a company's core profitability, is a very, very healthy 33.9%. That tells you the underlying business is incredibly efficient. And after a bit of a tough period, the stock has rebounded really strongly as the market starts to believe in its cloud and AI strategy. This makes it a potential turnaround story that also pays you while you wait.
And finally, let's look at Docebo. This is another software-as-a-service company, but their niche is corporate e-learning. They provide an AI-powered platform that helps massive global brands like Starbucks and Amazon Web Services train their employees way more effectively. AI is a total game changer here because it allows for personalized learning paths for every single employee. Now, the company's stock has faced some headwinds recently, along with the rest of the tech market, but the underlying business continues to tell a very compelling long-term growth story.
And this is where a potential opportunity for investors comes into play. Despite the recent pressure on its stock price, the company's actual business remains strong. Revenue keeps growing at a double-digit pace, and maybe more importantly, its profitability is rising over 20% year over year. For a new investor, valuation is a super important concept. It's basically the price you pay for a piece of the business. After the recent stock price drop, Docebo's valuation has become much more appealing. This could make it an attractive pick for investors with a long-term mindset who see that disconnect between the stock's recent performance and the company's solid results.
So we've looked at some pretty powerful Canadian options. Each one has its own unique story and risk profile. But what if you want to get exposure to those big US names you hear about every day? Or what if you just prefer a more diversified all-in-one approach instead of trying to pick individual stocks? Let's look at how you can do that.
There are really two main paths here. First, you can buy individual US stocks like Nvidia or Amazon directly through your Canadian brokerage account. The upside? You get direct ownership in these global leaders. The downside is you have all your eggs in one basket, and you have to be mindful of currency conversion fees, which can add up. The second path is buying a Canadian-listed exchange-traded fund, or ETF. An ETF is basically a basket that holds dozens of different stocks. Funds like RTI or IGO give you broad exposure to the global AI industry in a single purchase. Others, like CHPS, are more specialized, focusing just on semiconductor companies. The big advantage here is instant diversification, which lowers your risk. The trade-off is you'll pay a small management fee for that convenience.
Okay, we have covered a tremendous amount of ground. We've gone from the basic definition of AI to deep dives on specific Canadian companies and even broader investment strategies. Now, let's boil it all down into a few clear, actionable principles to guide you as you start your investing journey.
Here are 3 rules to always keep in mind. First, think long-term. AI is not a get-rich-quick scheme. It is a multi-decade technological shift. The real wealth creation is likely going to happen over years, not weeks. Second, be extremely careful with penny stocks. You're going to see a lot of small, speculative companies with AI in their name. These are often incredibly volatile and can be very, very risky for new investors. And third, and this is the most important one, always evaluate the fundamentals. Don't buy a stock just because of the hype. Look at its business model. Does it have a real competitive advantage? A moat? Is it actually profitable? Does it have a strong balance sheet? Remember, you are not buying a lottery ticket. You're buying a piece of a real business.
We've definitely covered a solid foundation in this video. For those of you who are ready to go deeper and really learn how to analyze a company's financial statements line by line, you can subscribe to the membership. That's where you'll get access to exclusive videos on analysis of financial statements of public limited companies listed on stock exchanges around the world, which are not available to others. There, we break down the actual numbers to show you what separates a great investment from just pure hype. Thank you for watching.